Well, I think it is extraordinary because it takes a lot to bet against the banks.
Can you give us some idea of how significant this is?
Well, look, I suppose it's people are putting money where their mouth is a bit. Like when you're looking at this type of shorting, it's not something we've really seen before, and I suppose it's not always a good indication of what's going to happen in markets. But when I guess there's a lot of sense behind it, like it does make sense that banks are going to have a bit of a rough time. I think it just makes us and probably should the public in general just stand up and listen to what is happening.
Yeah, and indeed on that, why do you think investors are shorting the banks? What's behind it all?
Well, look, there's a few things, and one, I guess, is valuation. So when you look at our banks, and probably CBA in particular is the one that is the most expensive one, and investments are valued at multiples, so multiples of earnings. CBA is at between 26 and 27 times. When you compare that to other banks in the world, so something like JP Morgan as an example, like that's about 14 times. That's the biggest bank in the States. It's very well governed, very well diversified bank. Hard to see how one of our banks can be that far ahead of them in valuations. So valuation is definitely one of them, and look, that hasn't changed too much in the last 12 months. But I guess what has is probably our economic situation here in Australia, and probably come from a bit of a situation where, look, we had a bit of confidence in the market, we had interest rates coming down, we've now got some sticky inflation, some worldwide turbulence, as well as now the actual interest rates are going the other way. So that puts a lot of pressure on borrowers. You've got people now borrowing at really high interest rates. Their savings are depleted, and so we've got stresses now in terms of their ability to meet their loans. So that's an issue. The actual forecast for credit growth is not looking great. So when you've got sizes of loan coming down, obviously that's a reduction in what the banks are going to profit from. So immigration's come off, and that's probably a bit of an issue in terms of the recession probability itself, but less people borrowing, leading to that reduced growth. We've got housing prices come off, so people need to borrow less. That's, I guess, plays into that as well. And then when interest rates come up, people can actually borrow less than they could before, and so that's sort of playing into that credit growth. So a few things are sort of going down that path where the banks look like their earnings are going to be impacted, and that's then going to flow on to dividends. It's going to compress their multiples at the same time.
Steve Landers, the Commonwealth Bank was heavily shorted the day after Jim Chalmers handed down his fifth budget. Now, was that related to the proposed, at the time, tax changes, do you think?
Yeah, look, definitely something to do with it. Like there is a bit of a down in sentiment, and I think what we're going to see is probably a lot of investors exit this market. And I guess as an advisor, we speak to clients every day, and a lot of them have investment properties, and from their eyes, I guess we see cost of entry into property really expensive with the stamp duty. Once we've got the property, we've then got land taxes, especially in Victoria, being quite hefty, as well as higher interest rates, so those borrowing costs are really expensive. We've now got the past benefit of negative gearing is now gone, so that's not a benefit year to year for people. When we're selling it, we've got a reduction in the capital gains tax, and also along the way, I guess everyone's complaining about the rights they have as a landlord, and it's pretty much non-existent. So I can't see anyone actively trying to find investment properties as part of their portfolios when you're not making money on an annual basis. You're not making money at the end. If you are, you're being taxed pretty heavily on it. When even term deposits, you're at 5% now with no risk. You don't have to go fix up the plumbing. You've got no taxes along the way. It's a lot easier situation than something like property. So I think coming back to, I guess, your question about CBA, look, I think that definitely was a bit of a contributing factor to their share price. Like the valuation, as I said, is ridiculously high, but it was there before. It's now some of these other things like government policies, property prices coming off, and these other ones that are starting to impact their share price.
Now, I don't want to put too fine a point on it, but the amount of money being shorted here is quite extraordinary, north of $10 billion. Is it telling you something about the property market itself, or indeed the economy?
Well, I think it's both in general. Like I think we're probably in a bit of a hard time here in Australia. When you look at our real GDP, it's minimal. I think it was 0.3 last quarter. And from a per capita basis, we are in recession. So what is propping our economy up currently is immigration. But at the same time, we've got such its popularity for One Nation and their immigration policies, and Labor's taking on some of that from a political point of view to reduce immigration. And so reducing the thing that is keeping us out of recession potentially leads to a recession. So I think the economy in general is a bit of an issue here for us. The other thing, I guess, there's been such a big inflow of index fund investing, and some of it's sort of the mums and dads that are jumping into this just through things they hear in the newspaper and friends, and just seeing the stock market do quite well. But on the other side, I guess it's the industry funds, and they're piling into these index investments, mostly because of their performance testing. They have to sort of stick with the bench line, but it's by no means diversified at all. Like, we've got our top 10 stocks making up 50% of our ASX 200. And of those top 10, we've got 6 of them are banks. So that's not great, I guess, when you look at that kind of thing. And if you think the banks are going to come off and potentially in a big way, what that does to the whole ASX 200 and all the investors that are in there as well. So I think people are sort of, into these investments, looking at the upside, thinking they're diversified, where something like this comes along and potentially changes the whole situation for them.
Very, very briefly, many have pointed out that banks, as you have mentioned, banks were already overvalued, and the falls and the amount of shorting isn't really particularly extraordinary. Would you basically agree with that, though?
Well, I think it is extraordinary because it takes a lot to bet against the banks. Like they are, a bit of a darling in Australia, but at the same time they're not. They're not immune to falls. Like in COVID, they dropped 30%. GFC, they dropped 50%. They didn't recover till about 2013, their share price from that point. So if you're willing to hold that, on the way down and potentially be where you are in 5 years, 6 years' time, like that's, it's a big risk on there. I guess what we look at as is alternative investment. So what can we get into that is still going to go well in this type of environment? And there's always something, like money doesn't disappear, it flows from investments to other investments. And so, things that we're looking at a bit more are things like our infrastructure type investments, things that are a little bit inflation proof, critical assets, they're still going to be there and still making money through a recession type of period. So, there's options for this, but I don't think it's, I think it's probably warranted that the people are jumping off these things because, at best case, they don't make money. At worst case, they drop a fair bit, in my opinion, anyway.
Well, Steve Landers, it's been great to get your insights today. Thank you for joining the business.
That's all right. Thank you.